All right, welcome to the Explainer. We're going to tackle a question today that I think keeps every investor up at night at some point. You open your app, you look at your portfolio, and it's just a sea of red. And that one thought just screams in your head. Where did my money go? It is just a gut-wrenching feeling, right? Seeing those numbers that you worked so hard for just evaporate. It literally feels like someone reached into your bank account and just took the cash. But is that really what's going on here? Well, the answer might actually surprise you. And spoiler alert, it's a whole lot less sinister than it feels. Okay, let's try to wrap our heads around this with a really simple analogy. Think about buying a brand new car. The second you drive that thing off the lot, what happens? Its value plummets. But the car itself hasn't changed, right? It's the same car, same engine, same wheels. What has changed is what people are willing to pay for it now that it's used. The stock market? It's a lot like that. So here's the absolute key, the big takeaway. The money doesn't actually go anywhere. It doesn't disappear into a black hole. What changes is the perceived value of your investment. See, a stock's price is just what the last person was willing to pay for it. So when prices fall, all it means is that the collective opinion, the vibe, if you will, about that company's future has soured. People just aren't willing to pay as much for it anymore. So the value is reduced, not transferred. All right, so let's get right into our first section here and just bust this myth wide open, the myth of vanishing cash. This is a really important point that separates investing from, say, gambling. Think about a poker game. For you to win $100, someone else at that table has to lose $100. It's a zero-sum game. But the stock market, it's different. It's not a zero-sum game. It allows for everyone to win together. That's collective value creation. And unfortunately, for everyone to lose together. That's collective value destruction. So when your stock price falls, that money isn't being directly transferred into someone else's pocket. And if you want to understand the sheer scale of this idea, just look back at the 2008 financial crisis. An estimated, wait for it, $17 trillion in household wealth just evaporated. Now, that money didn't all get funneled into some secret villain's offshore account. No. What happened was the perceived value of pretty much everything, stocks, houses, you name it, just plummeted across the board. The entire economic pie got smaller for everybody. Okay, so if the money isn't just vanishing into thin air, then what is causing these wild, dramatic price swings? Well, it really all boils down to a couple of core principles. It's the oldest rule in the book, right? Economics 101, supply and demand. The best way to think about it is like an auction. If there's a rare painting and a dozen billionaires are all bidding against each other for it, what happens to the price? It goes through the roof. That's high demand. But if the auctioneer is trying to sell something and crickets, no one's bidding, they have to keep lowering the price just to get someone interested. That's what happens when there's a high supply of sellers and not enough buyers. Let's make this real. Look at Tesla between 2020 and 2021. The stock shot up over 700%. Why? Simple. Investors were insanely bullish, everyone wanted a piece, creating this massive, overwhelming demand. Now, flip that. Remember when Netflix in a single day in 2022 just cratered almost 22%? That was because they reported disappointing subscriber numbers. Suddenly, fear kicked in, and a flood of people wanted to sell, completely overwhelming anyone who was looking to buy. So, what causes this imbalance? What spooks the market? Well, sometimes it's really specific to one company. They had a bad earnings report. But other times, it's a huge wave of fear that washes over the entire market. We're talking about big stuff, like fears of a recession, the Fed raising interest rates, or, major geopolitical events. And this brings up a really, really important distinction you have to understand. The difference between a company's intrinsic value and its market value. Think of intrinsic value as what the company is actually worth, based on its assets, its profits, the real nuts and bolts. Market value, on the other hand, is just what people are willing to pay for it today. And that price can be wildly emotional. In a full-blown market panic, the market value can drop way, way below what the company is fundamentally, intrinsically worth. Okay, so all of that theory is great, but let's get down to brass tacks. This is the practical part. What does all this mean for the actual money in your portfolio? All right, so this brings us to a term you've probably heard, an unrealized loss. People also call it a paper loss. It's simple. Let's say you bought a stock for $100. You check it today and it's trading at 80. You are now looking at an unrealized loss of $20. It feels bad, for sure. But here's the key. It's not final. It's only on paper. You still own the exact same number of shares in that company, and there's always the potential for it to bounce back. Now, a realized loss, that's different. That is what happens the moment your fear takes over and you hit that big red sell button. The instant you do that, you've taken that paper loss and made it real. You've turned it into an actual permanent loss of your capital. The deal is done, the loss is locked in, and yeah, that money is now officially gone. And this chart here really lays it all out. On one side, you've got the unrealized loss. Yeah, your portfolio value is down, but there's no tax impact yet. And most importantly, recovery is still on the table. On the other side, the realized loss. You've now actually shrunk your investment capital for good. Now, the one small upside is you might be able to use that loss to offset taxes on other wins, but the point is, you are the one who makes the loss real by choosing to sell. So, now that we understand this crucial difference, the big question is, how do we handle it? How do we prepare for these market storms and actually respond with a clear head instead of just pure panic? It's time to turn that panic into a plan. Every smart investor has a playbook, and it's usually pretty simple. First, diversify. Don't put all your eggs in one basket, so one bad stock doesn't torpedo your whole future. Second, always keep some cash on the sidelines. Why? Because that cash is your opportunity fund. It lets you buy great companies when they go on sale. And third, know your risk tolerance and use tools to protect yourself from a complete wipeout. Because at the end of the day, it really all comes down to this. Investing is as much a game played inside your own head as it is on a spreadsheet. The truly successful, long-term investors are the ones who master their own emotions. They're the ones who can stay calm and stick to their plan when everyone else around them is losing their minds. So let's just wrap this all up. The next time you see your portfolio in the red, I want you to remember what's really going on. No one is stealing money from you. It's just that the collective opinion about what your stocks are worth has changed for the moment. And that scary-looking number on your screen, it's just a paper loss. It only becomes a real loss when you decide to hit sell. And that really leaves us with one final crucial thought. A market downturn, it doesn't just test your stocks. It tests your discipline. It tests your nerve. So when the next one hits, and trust me, there will always be a next one, the only question that matters is who are you going to be? The investor who reacts with fear or the one who responds with a plan?